Good morning, everyone. Thank you for joining us and welcome to a New Hampshire Business Review webinar, Current Economic Trends Informing Financial and Estate Planning Strategies. I am Ernesto Verdin. I'm the publisher of New Hampshire Business Review, and it's really a pleasure to be here with our two speakers today. We will be hearing from Susan Martore-Baker, President of Cambridge Trust of New Hampshire, and Ryan Hanna, Senior Vice President, Deputy Chief Investment Officer, and Director of Equities at Cambridge Trust. Our sponsor today is Cambridge Trust, and we are going to hear first from Susan and then from Ryan. And we will begin now. Susan, come on up.
Actually, Ernesto,
Ryan. Oh, I got it. I'm sorry, I got it backwards. I was looking at the pictures in the order they were displayed and not thinking. That's what happens when they just have me reading a teleprompter. Ryan, we'll hear first from you and then from Susan. So Ryan, welcome and thank you for being here.
Thank you for having me. It's a pleasure to be here. A couple of weeks ago, Susan and I sat and started talking about this presentation. And one of the comments I made to her at that point was the fact that the world changes so fast, and a lot of the information that was relevant a couple of weeks ago maybe is sort of less relevant today. And we can see that no more than what's happening in the Middle East right now. The world changed in 4 days. So the travesty that's happening in the Middle East with Israel and Hamas is sort of on everybody's mind. Sadly, I don't have a lot of slides or any sort of economic implications to address here, but it's just another reminder of how quickly things change in the world today. So with that introduction, I'm going to take about maybe 15, 20, 25 minutes this morning to go through some slides talking about the economic environment that we're living in today. Talk about interest rates, housing, inflation, consumer balance sheets, government shutdown, which has been averted for the time being, but is still quite likely at some point in November, and then provide a few reasons to be optimistic on the outlook for the future. And then hand it over to Susan to talk a little bit about portfolios and estate planning strategies and so forth. So with that, I will pull up my screen here. I thought I'd lay the groundwork here with just a little bit of a lay of the land for 2023 and what markets have done this year. Quite surprised. I mean, it's been a really confusing market for the most part. Very little has been normal about this year or the last 15 years post the global financial crisis. But just to kind of provide some perspective, in the top left quadrant here, I have U.S. equities, and I have them broken down into a lot of different sort of style boxes or different categories. So S&P, which is the broader measure of the U.S. market, is up 13% through the third quarter, which is quite strong and much better than most people expected coming into the year. The NASDAQ is up over 27%, twice what the broader U.S. market is up. And then a couple of sort of nuances here. If you were invested in sort of growth-related stocks, you're up almost 25%, and value stocks are up only about 1 or 2%. So a pretty wide margin between growth and value. Russell 2000 is a pretty good proxy for small cap stocks. So the difference between large and small is about 13% to 2%. So a pretty wide gap there. And then dividend-related stocks are flat to down, and that's related sort of to this value trade. Defense has underperformed while offense and growth has done quite well. You can see on the bottom left quadrant, communication services, consumer discretionary, and information technology are up all 25 to 35 to 40%, while the much more defensive sectors, as I alluded to earlier, are flat to down. So you've got financials down, healthcare down, real estate, utilities down. So it has been a very growth on type of market environment. My next page. The reality is, in the world we live in, there's always something to worry about. You can go back over the last 5 or 6 years, as this chart does. But the reality is, whether it's headline related or there are real issues facing the economy and the world, we always have issues. You could think about Russia and Ukraine invasion back in 2022. There's always issues around political or geopolitical issues that are out front and center. We had COVID, which we dealt with, and the ultimate reality is, for long-term investors, these are sidetracks. They're little blips in sort of the long-term trajectory of returns from stocks and bonds to some extent. But we tend to think of these dislocations in price or these things to worry about as opportunities, and we tend to use that as opportunities to buy good quality companies. Transitioning a little bit to interest rates. This is a chart going back to 2008 of Fed funds rate and the US 2-year Treasury. You can see, just in general, they're very highly correlated. So as the Federal Open Market Committee raises interest rates, the 10-year tends to rise with the Fed funds rate. And really of note here is, post-global financial crisis, we've had interest rates at extraordinarily low levels. And the pace of change over the last, let's call it 18 months, where we've gone from 0% for a 2-year US Treasury to more than 5.3%, sort of a historic sort of ramp up in interest rates. And I think that's concerning to some in the economy, and we'll talk a little bit more about short-term rates and long-term rates as I go on. This is a 10-year US Treasury. This is more related to housing, and we'll see on some of the upcoming slides some of the headwinds we're facing due to the fast increase in interest rates. But a couple of takeaways from this particular chart. Certainly the 10-year US Treasury is much higher than it's been over the more recent past. But if you look back, we're in a sort of path where we were back in the early 2000s. So I would call this more of a normalized interest rate environment. And it's below where we were in the 1990s and certainly in the 1980s. And I think we're becoming a little bit more normal. So we've been spoiled by extraordinarily low interest rates over the last decade or 12 years post-global financial crisis. But I think we're in a much more normalized interest rate environment. And that might give you a little bit of indication on why we really haven't felt the pressure on the stock market just yet. This is a normalization back to trend. On the other hand, these are mortgage rates. And anybody who has been involved in housing over the last decade or 25 years, feels this imminently here. Right now we're at almost 8% for the national 30-year fixed national rate for mortgages. Again, the change in trajectory going back to 2022, when mortgage rates were 3%, to where we are today at 8%, bringing us back to levels not seen since the early 2000s. This has put tremendous pressure on housing. So housing-related existing home sales have fallen off a cliff. And not surprising, as interest rates have risen and prices remain very firm on the housing front, we've seen housing turnover slow pretty dramatic. Again, not extraordinarily surprising. And if you look at this chart here, at the top, this is the Federal Reserve Bank of Atlanta's home ownership affordability monitor. When it's green, houses are more affordable, and obviously when they're brown, much less affordable. So the combination at the bottom, you can see price change and interest rate change has driven affordability for housing down to levels we haven't seen since the Great Financial Crisis or just before the Great Financial Crisis. So if you're a new homeowner, this is going to be a much more difficult environment for people to buy houses because prices remain extraordinarily elevated. If there is one silver lining to this chart, it's the fact that nearly 90% of consumers, homeowners, locked in interest rates at nearly 3%. So they're not feeling the pressure of higher interest rates because they're locked in at much lower interest rates. These three charts do a pretty good job of showing that this is an estimated monthly mortgage payment. And you can see back at 2021, the average payment was about $1,400. And today we're closer to $2,600. So the estimated monthly payment has gone up pretty dramatically. However, the mortgage rate relative to the current rate is about 3.5% lower than where we are today. So when we looked at existing mortgage rates at near 8%, that's not what most people are paying. Most people are paying closer to 4 or 4.5% as a general rule. And if there's one other silver lining in terms of the housing market, it's this bottom chart. Mortgage originations by credit score. And you can see most of the housing related activity that we saw over the last 3 years has been in the demographic of credit scores above 760. So unlike the period back in 2000 leading up to the great financial crisis, when credit quality was much lower and the credit scores of the borrowers were much lower, the current housing market seems a little bit more stable and I think probably a lot more resilient than it had been in the past. This is really an interesting chart. This is a trend of retail sales, so adjusted retail sales and food, going back to, again, the great financial crisis. But note, I guess, is you had this perfect sort of trend, and the red line indicates the middle of the trend going back over the last 13 or so years. That trend is way off at this point, fueled by stimulus related to COVID. When people, when COVID happened and everybody was forced to stay at home, and we received payments, stimulus payments, retail sales spiked. We had no other things to spend money on. We could not take trips, but just notice how far above trend we are at this point. We ask ourselves whether this is a new sustainable trend at a much higher level, or whether consumers are starting to feel tapped and we'll start to see a significant slowdown in terms of consumer spending. This is a data point we're watching quite closely. Similarly, this is revolving consumer credit. So the amount of credit outstanding on credit cards, it's over $1.2 trillion cumulatively. But similar to the last chart, an up and to the right trend is not necessarily worrisome. Because as growth happens and as the economy grows, you can expect an increase in credit. But what's worrisome is this red line. It's just the trajectory of consumers that are using credit. So that speaks to a much louder point, which is, consumers maybe are running out of savings. They're running out of the money that they had during COVID, and they're having to tap into credit cards to survive, to pay for groceries, to pay for gasoline, and to pay for normal living expenses. So again, this is just another headwind facing consumers that we see. Related to that is a handful of data points that we watch very closely. These are 30-day delinquency rates, and these are 4 major credit card issuers. You can see Discover Financial has already surpassed pre-COVID levels in terms of the number of people who are more than 30-day delinquent on credit card payments. Synchrony Financial is up, Capital One is up, Amex, who tends to skew towards a higher income demographic, is higher, but certainly not back to the levels we saw pre-COVID. So that actually, we'll get to that in a second, but that is an important caveat and something to keep in mind as we go forward. Just higher demographic, higher income demographic consumers remaining a little bit better off than the lower income consumers based on inflation and a lot of other details. This chart sort of echoes what we just talked about. This is personal savings as a percentage of disposable personal income. The trend has been about 7% going back to the early 1980s. During COVID, it spiked over 30%, and it rests just under 4%. So well below the average, well below trend. But again, it just points to the fact that consumers are using up savings that they had set aside. This is the demographic chart that I was referencing earlier. This is excess savings. So going back to COVID, everybody built up excess savings. And for the bottom 80% of the US population, we're now below the level that we were in pre-COVID levels. The only demographic, which is the over 80% level demographic, remains with excess surplus, but that's dwindling fast as well. So the consumer is facing a lot of different headwinds, whether it's interest rate or otherwise. One other thing that we think is a headwind for consumers, student loan payments have restarted. So again, that pre-COVID range of about $1.5 trillion in student loan payments coming in has fallen. And obviously with the student loan payments restarting, we're starting to see another incremental headwind on consumer. The average student loan, somewhere between $250 and $300 a month. So as that money is redirected back towards student loan payments, it's another headwind towards consumer spending. Bears watching. Oil prices, $90 a barrel or thereabouts. And if you haven't picked up on it, the basic premise here is really that we feel like the economy is facing a lot of headwinds. The consumer represents almost 2/3 of GDP in our domestic economy, and as all of these factors continue to pile up, we're very cautious on the consumer, but as a sort of extension, the market. Government shutdown. This is an interesting chart, and as I mentioned at the onset, between the time we started planning for this presentation and the actual presentation, Congress pushed through an extension through November that delayed the government shutdown. But these charts, I think, are still relevant in the grand scheme. These are just keyword searches on government shutdown. It became a much bigger issue. People were much more worried about it as we approached the deadline back at the beginning of October. However, the data skews mixed relative to how markets perform either before or after government shutdowns. On the left, this is performance during government shutdowns. So you can see it ranges from down a couple of percent to up almost 8% in 2019 during the last government shutdown. The average government shutdown in terms of days is about 8 days. But the last 3 shutdowns, or 3 of the last 4 shutdowns, have been decidedly longer, somewhere between 2 weeks and a month. So again, it's something to be thoughtful and be thinking about. But I have 2 or 3 counterpoints to that, and this is where the presentation will get to be a little bit more incrementally positive, I think. If we focus on the 3 lines towards the middle of the chart, the biggest takeaway here is equity markets usually pull back in anticipation of a shutdown. So you see this pullback line item here. On average, leading up to a government shutdown, markets have pulled back somewhere around 10% on average in each of the periods leading up to that. During the shutdown, again, performance in the stock market is more mixed. And after the shutdown, 12 months hence, average returns are actually quite good, 18% on average, and the median return is closer to 19%. So Maybe that's a sign that fiscal austerity as a result of some of the decisions that happened during the government shutdowns will be positive for markets going forward. So we don't necessarily view government shutdowns as being a long-term headwind towards equity markets. And we would use, again, pullbacks to be opportunistic. One of the most important traits or trends of this particular cycle, which is different from past cycles, is jobs. One of the reasons why we haven't had a recession thus far, despite the fact that it's been predicted by a lot of economists and other professionals, is the jobs numbers. Right now, unemployment rate is about 3.7%, remains below 4%. Jobless claims remain close to about 200,000, which is a pretty healthy number in the grand scheme of things. And we do still see dislocation in supply and demand for labor. So currently, the labor force is about 167 million in the United States, but the number of unemployed and the number of job openings total about 171 million. So there's about a 4 million person or job dislocation that explains some of the strength in the job market. It also helps explain some of the changes that we've seen in the wage component of the job market. Fewer people are staying longer. People are getting more raises, higher raises. Again, that bodes well for consumer spending. It also bodes well for the overall economy. Getting close to the end here. This is a survey by economists, and I guess the real takeaway to me here is there is a growing consensus that we could actually see a soft landing in the economy. If you look at whether it's Fed funds rate or GDP growth, the trend for Fed funds rate right now, we're currently somewhere around 5.35. Markets expect, or economists expect, that number to come down by 50 basis points, almost 100 basis points next year. And it expects, almost 250 basis points of interest rate cuts by the Federal Reserve by 2025. That's the blue line, 2026, the yellow line. But we're going to see GDP growth pretty stable at about 2%, which is the long-term average and actually is quite good. Unemployment rate, by most forecasts at this point, only expected to rise to 4.5%. It's hard to see us having a hard landing or a deep recession if the unemployment rate only gets to 4.5%. I think that would be considered, a soft landing. And then inflation metrics back to 2%, which is the Fed target by 2024, 2025, 2026. So the trend, at least by most experts, is that we may actually pull off, or the Federal Reserve might actually pull off a soft landing. Inflation trending down. This has been quite notable. We had a CPI data point this morning, which was exactly 3.7%. But the trend, going back to June of last year, where we peaked CPI at 9.1, we're all the way down to 3.7%. The Fed is concerned that we see a double dip or a double spike in terms of recession or CPI inflation, which is why they remain so diligent in keeping rates higher for longer. But if we see more softness in the inflation components of CPI and the PCE, again, I think that gives the Fed more cover, and it does sort of build up more the soft landing scenario. Despite rates being higher, in some cases, that's a good thing. And we'll start to maybe kind of bring it in towards individual securities or asset classes and asset allocation before I hand it off to Susan. This is just a look at different fixed income investments. And if you look at the US Treasuries, we'll start there. The gray bar is the 10-year range of where US Treasuries have been over the last 10 years. 1.6 is the median. And you can see we're at 4.8%. which is just about 10-year highs. And whether it's municipal bonds, investment-grade corporates, mortgage-backed securities, asset-backed securities, almost across the board, yields are as high as they've been in 10 years. So if you're a fixed income investor, or you're depending on a fixed rate of income or fixed income stream, this is the best we've seen in more than 10 years in terms of the interest rate environment. While may not be good for housing, may not be good for valuations of stocks and other things, it's definitely good for savers, and it's definitely good for investors that need fixed income, because it's been a long time since we've been there. I thought this was interesting because this is Fed funds rate, but what it shows is expectations for the FOMC expectations in dark blue, the market expectations in green, and then the Fed's long-term projection of Fed funds rate at 2.5%. If you look at where we are today, we're nearing the peak in terms of interest rate pressure on the economy. If the economy was to slow, the Fed would likely cut. And the market is pricing in some of the expectation that these interest rate cuts will happen. Another positive, and this is sort of more in my domain, in my world, earnings. Corporate earnings in the market matter, and they matter because they drive stock prices. Q3, which is the quarter we're about to hear about upcoming here, will be the first positive growth rate year over year in terms of earnings growth that we've seen in 6 or 7 quarters. We've seen decelerating earnings growth over the last 6 quarters, and this will be the first inflection positively. And if you look at the next 4 to 5 quarters out, corporate earnings are forecasted to grow. Again, why is that important? Because corporate earnings drive stock prices. About 97% of stock prices can be explained by corporate earnings. So if earnings are going up, stock prices should be going up, which again is good for equity investors. All of that said, one of the primary reasons to be bullish on the US economy at this point is related to artificial intelligence or generative AI. Sure, everybody has heard about it. I'm not going to get deep into this slide here, but I thought it was very, very appropriate to show some of the broad applications that AI is being used in or will be used in the future. The major benefit of increased use of artificial intelligence is productivity gains and efficiency gains. That should help corporate margins, should help corporations reduce costs while maintaining pricing, and overall help corporate margins on a go-forward basis. But this is really an intriguing kind of slide because it's not just technology where the benefits will accrue. You're going to see it in healthcare, you're going to see it in financials, digital content, retail freight, energy and industrials. Customer service is a big component of that. So this is a really, really important part of the long-term bullish viewpoint on US markets broadly. I'll bring it in for a landing with a couple of final slides. I think there's a lot of reasons to be bullish and bearish. I think the bearish arguments are front and center in news and what we see every day on nightly news or in the newspapers. Government shutdown, an upcoming presidential election, which is likely to be contentious. We have obviously the war in Israel with Hamas, and not to mention that we still Russia-Ukraine is ongoing. So there is a lot to be concerned about. And I think that again provides some opportunities when markets pull back. I talked about artificial intelligence being a huge long-term positive. We have a lot of digitization and automation in our economy and workplace that's ongoing. I talked about mortgage rates being fixed and not interest rates maybe not pressuring the consumer as much as it has in the past. So again, it's a very balanced market out there. I have 3 slides to finish up before I hand off to Susan. And this really will sort of segue well into some of Susan's talking points. The gray bars are S&P returns every year going back to 1980. The red dots represent intra-year pullbacks. So every year going back for the last 43 years, the average intra-year pullback is about 14%, meaning every year there's pullbacks in the market. Markets go up, markets go down. However, 74% of the time markets go up. 32 out of the last 43 years, we've had positive returns for equities. Again, it gets back to the earlier point of being opportunistic when markets go down, being opportunistic when headlines hit that cause markets to go down. More than likely, stocks will rebound in a short period of time. There's only been this one period back in 2000 where we had 3 consecutive negative years in the stock market. So again, be opportunistic when markets correct. Really interesting slide. Again, it gets a little bit into the asset allocation considerations, risk tolerance, time, and diversification. I'll walk through this really quickly. The green bar is stock returns. On any one given year, you could be down as much as 39% or as high as 47%. And this goes back to 1950. We're looking at almost 72 years of data. So any given year, the volatility is quite great. If you look at 5 years, though, the worst 5-year return for equities, if you were an all equity investor, was minus 3%. The best period was plus 28%. And as you move further out the time horizon, your worst 10-year equity return was only -1, but it was plus 19, 10-year compounded. Bonds provide less volatility, but typically a lower return. So your worst bond return will be -13. It could be up 43%. And then this is sort of our domain where we live in that 50-50 balanced portfolio. If you look out over time, a diversified portfolio of stocks, bonds, cash will provide reasonable rates of return over a longer period of time with much less volatility. And I think that's an important component for diversified clients, people with diversified portfolios of stocks and bonds. Busy chart, but I really like this chart. I'm sure it'll be a little bit hard to see. And the basic takeaway here is that asset allocation portfolio of this one is 60-40, always ends up in the middle somewhere. You're never going to have the highest returns. You're never going to have the lowest returns, but you're going to get there. And on the far right, we have volatility. You're going to have a reasonable rate of return, somewhere around 6% per year, with much less volatility than REITs as a specific asset class, or small cap stocks, or emerging market equities. On any given year, emerging markets might do quite well. 2009, 2017, they did extraordinarily well. But 2011 and 2018 and 2021, they were the worst performing asset classes. So a diversified portfolio, stocks, bonds, cash, makes a lot of sense in sort of the long-term trajectory of building portfolios for clients. So I'm going to turn this over to Susan. Appreciate your time, and I'll hand it off to Susan. And I look forward to questions afterwards too. Thank you.
Super. Thanks very much, Ryan. Well, we just heard Ryan describe the current state of the economy, the positives and negatives of investing in the stock and bond market. It sounds like we're hoping for a government shutdown to take advantage of that decline. Anyway, let's explore how different investments can actually provide different benefits in addition to posing differing risks. Investments can be used efficiently in specific accounts. The key really to keep in mind, as Ryan said, is the overall asset allocation, the one that's right for your money An overall allocation that offers the right amount of risk, growth, current income, safety. If you keep in mind your ultimate goal for your money, you can put the correct investments in the right accounts. For instance, in a taxable account, an investment account is either in a single name or in joint names, or a revocable trust account when the donor is still living. Those accounts, if growth is a goal, can use equities efficiently when held in a taxable account. If a stock goes down in price, the realized loss can be used to offset gains in other securities when they're sold. It's called tax loss harvesting. Stocks often pay a dividend, and the federal tax rate on dividend income is typically about 20% or less in most cases under current law. That may be significantly less than the taxes that you pay on other income. Another benefit of stock investing in a taxable account is the step up in tax cost basis on death. If you paid $10 a share for a stock 10 years ago, and it's now worth $100 a share, you'd have a $90 capital gain tax if the stock was sold. But at the owner's death, the shares receive a step up in tax cost basis to the date of death value of the stock. So the gain goes away and the stock can be sold without a capital gain liability. It's probably the only benefit of dying. Another benefit of a stock in a taxable account, if you have any charitable intent for your money, shares of stock can usually be given to a charitable organization without selling them and causing you a tax liability on the gain. Instead, the shares are transferred to your chosen charity, and you get the benefit of the full market value of the donation. When the charity sells the security, there's no tax since they are a tax-exempt organization. And finally, historically, stocks provide the most potential for growth. We saw that in a lot of Ryan's charts. So growth in a portfolio over a long period of time really can utilize stock investing. But what about tax-deferred accounts like an IRA? Depending on your age and the amount of time the funds will be invested in an IRA, you might consider putting the fixed income portion of your overall asset allocation in the tax-deferred account. When distributions are required to be made from an IRA, they're called required minimum distributions, typically at age 73 or sometimes later. Distributions are treated as ordinary income. Remember, ordinary income tax rates may be relatively high if you have other income. You can't take advantage of the lower tax rate on dividends like we saw in a taxable account, and you can't tax loss harvest if an investment loses value. You also do not get the benefit of a stepped up tax cost basis at death in an IRA. The entire account is taxable at current tax rates when distributions occur. The hope is that when you do begin to take distributions, you'll be in a lower tax bracket, but that's not always the case. You can also make qualified charitable distributions from an IRA, which eliminates the tax for you altogether on the required minimum distribution in an amount up to $100,000. And that provision in tax law was made permanent. Bonds or fixed income, however, don't offer the returns that stocks offer. So it's important to consider the time frame for your investment when deciding on the assets to put in a tax-deferred account. Finally, charitable accounts. Always consider using low cost basis securities for any charitable gifts. In particular, a charitable remainder trust, when you can transfer a security that has a large capital gain to that trust in kind. The trust can sell the security with no tax liability because the ultimate beneficiary, again, is a tax-exempt organization. The trust then provides cash flow to the donor or really to any named beneficiary at the beneficiary's death. The remainder of the trust is given to the charities named by the donor. There are specific requirements that the IRS imposes on a charitable trust, and there are variations of charitable remainder trust. The payout rate depends on the age of the beneficiary, But this type of trust avoids capital gain taxes on the transferred security. It secures cash flow to the beneficiary, and it can provide a higher distribution rate than other investments, again, depending on the age of the beneficiary or beneficiaries. Charitable trusts offer a great deal of flexibility for anyone who has securities with built-up capital gains and the intent to make charitable contributions at death. Bottom line with charitable gifts, though, don't give cash. If you have securities that have capital gains embedded, always gift the securities in kind. So I started the discussion with the point of figuring out what the correct overall asset allocation should be for your wealth. You'll see on the last slide that there are many factors to consider in determining your investment profile. Among them, who are the beneficiaries and when will they inherit? What are the assets and are there any liabilities? Current income, is it necessary or is growth the goal? How do you feel about losing money when the markets are down like they were last year? So investing can be extremely complex, and integrating your investment planning with your estate planning can optimize your results. It's helpful to consult a professional in your planning, but always be sure to consider your ultimate goals. Those are what's going to drive your ultimate asset allocation. Ernesto, do we have any questions?
We sure do. We sure do. And at this point, let's bring Ryan back up as well. Great material from both of you. Thank you so much for being here. Let's start with a question related to what you were just talking about, Susan, in terms of risk tolerance. And this also relates to what Ryan was covering at the end of his presentation, which is that balancing of the portfolio between stocks and bonds based on your risk tolerance. And if somebody's time to, let's say, if the time that they have to work with is shorter, is there an incentive to be more cautious or more aggressive with those risks? Like it almost seems like you could make an argument for both.
Ryan, you want to take this one?
Horizon matters. And I would say in most cases, you'd want to be much more cautious in the short term with your investments, and having higher levels of liquidity makes a lot more sense. And that's where working with Susan and the team, understanding liquidity needs is a very important part of how we manage money, because we can create cash flows that mirror or match people's needs along the way. The interesting point of your question is, if you think back over the last 15 years, when interest rates were zero, the answer might have reversed, because it wouldn't have made sense to have money in bonds earning 0 or 1% versus the alternative of having maybe a little bit more stocks. So there was a period 10 years ago where, that typical 60-40 portfolio of stocks and bonds might have been 70-30 instead, because you are earning more income in stocks than you are in bonds. Today, that has flipped, and now we can earn a really reasonable rate of return above inflation and take virtually no risk to get there. So it's an interesting question, but I would sort of say that the answer is less risk as your time horizon shrinks.
I'd also caution, Ernesto, that a lot of times as people approach retirement, they think they have to go to cash or go to 100% fixed income. When you think about it, you're not going to use all your money on day one of retirement. You may have a 20 or 30-year time frame. So a time frame is important, but consider that overall asset allocation and the ultimate goals for the money, what you need today versus longer term.
What are some of the impacts of we were talking about inflation, or Ryan was talking about inflation earlier, and what are some of the impacts on that, on the parameters that you look at when you're talking about liquidity with people in terms of what their needs are? Because it would seem if you're expecting inflation to increase or decrease, it would have some effect on that. And Susan, maybe specifically some of the things that you talk about with clients as they're trying to explore what they think they need.
Yeah, the real value of the dollar is what's so important. You know, we have people say, gee, I can get a 3% CD, it's very safe. And I work for a bank, so I wouldn't discourage that. But when you look at inflation impacting the value of that dollar, think about what a loaf of bread cost 20 years ago versus what it costs today. You know, you've got to have investments that are going to keep up with inflation.
Um,
Part of our team, we utilize financial planners to a large extent to help clients plan for these inflationary pressures. And a lot of the software that we incorporate into a plan, we can adjust inflation expectations higher or lower to provide the client with a real-time sort of feel for what their portfolio will look like. If our target inflation level is 3%, but it comes in at 5%, how does that change your financial plan 20 years from now? So utilizing the skill set of financial planning and some of the software tools we have available gives the client a real-time or at least a hypothetical view of what they can expect over the next 15 or 20 years.
Okay, I do want to remind the audience that we have a Q&A function. If you look at your screen and click that Q&A, if you have a question for Ryan or Susan, please drop it in there. We'll see it come in and we will get to it right away. Backing up to some of the things you were talking about in the very beginning, Ryan, you talked about the unemployment rate remaining really low. How is that happening despite the Fed's attempts to slow the economy?
Great question. The uniqueness of this situation post-COVID really makes this cycle different. You know, coming out of COVID, and we still have it today. There are issues with daycare. There are issues with retirees who were very, very close to retiring, who may have worked for another 4 or 5 years, but opted out of the labor force. So the dynamics of the actual labor force have changed a lot. People have retired early. People have opted not to come back in. We also have, you know, less immigration coming into the country and that's another pillar of growth that we had in the labor force that just isn't there. So there's 4 or 5 different components that have played into the labor force. You know, there's some conspiracy theories that companies are keeping job postings high just to kind of make sure that they have available people, or that they're keeping people longer. So this particular cycle to me is a lot different than what we've seen in the past, where you get a normal ebb and flow of workers and job postings. So it's hard to make sense. I think there'll be dislocations throughout. We've seen it on the service side of the economy through hotels and restaurants and airports and things like that over the last couple of years. That has improved, and those dislocations have gotten better, but we still have a lot of different, and I think that's where AI will eventually come in and maybe help some of these job issues that we have over the longer term.
Now, with the idea of people staying out of the economy or having chosen to retire early, is that something, Susan, that you're seeing amongst, you know, clients and as a general trend? Are people trying to plan for an earlier retirement? And are they making lifestyle changes to accommodate that, or how is it working?
Yeah, I think we are seeing more individuals, and there's more availability of financial planning. So as people learn about it, I know most organizations, investment organizations, offer financial planning, some for a fee, others not. It's critical to plan. I mean, we see that during COVID, people just left the job market, and they really did need to plan in order to be able to do that. I think we will see a lot more savings in 401k plans by younger generations. Everything I'm reading indicates that, the millennials and Gen Z, they get it. They've had the education through their companies. They understand the compounding and the value that you can ultimately earn. My 28-year-old son is saving in a 401k. I dare say when I was 28, I probably didn't. I think planning, saving, I think we're seeing a lot more of that, yes.
It's interesting that you're seeing more of that with a certain generation, and then at the same time, the data that Ryan showed that broadly savings are below pandemic levels, or below pre-pandemic levels. And what do you think that? Why do you think that is? Is it that habits for at least some people, and maybe it's those generations before millennials that got into a habit during the pandemic of spending in a different way, and they have not been able to change that?
I think inflation has a lot to do with that. Things just simply cost more right now. And if you don't have the income coming in, I mean, remember a 401k, that saving is occurring automatically. You don't make the decision every paycheck. But I do think inflation has a lot to do with that savings amount. People might be deferring less. They may be putting less in their savings or money market accounts. I think a lot of it has to do with inflation. Ryan, you might disagree.
Oh, no, the general trends in terms of spending have been, minus the COVID period. We had seen a dramatic shift towards activities over things. People opting to take trips, doing more real-time experiences. And we're starting to see that re-evolve again here post-COVID, where and we've seen it through, airfare. Anybody who's tried to travel or go to take a trip, the cost of going away is very, very expensive these days. But that's an underlying shift in how people are choosing to spend their money. They're opting to spend versus save. And there's going back to that chart, there's a natural ebb and flow that happens over decades where people will spend down and then they'll save. And I think what happened was people started saving more in 2008 after the financial crisis because they were scared. And then as tensions eased, they started to spend more. And we saved during COVID because we had no choice. And now we're spending again. So it'll be really interesting to kind of see how these trends shake out over the next couple of years. That retail spending chart that I had in there, that's eye-opening to me, because if there is a normalization back towards trend, you're going to see a huge headwind on the spending side of the equation, which means people will probably go back to either saving or paying down debt or other means of spending.
In terms of not only spending savings, but maybe thinking about equity, as people have seen here in New Hampshire, the equity in their homes perhaps double over the last couple of years. Is there a temptation to spend that?
Although much different than 2008, people have been much more disciplined. They have not tapped into equity as much. But the difference is that your consumer net worth, right? Your house price plus your retirement plus your savings is so much more elevated today because house prices haven't fallen. I think that gives people a little bit of comfort that they're still in a good financial position. The consumer balance sheet is actually quite strong because their debt, despite the fact that, your mortgage payment might be higher or you might have taken on a bigger house or a bigger mortgage payment, most people can afford it because they financed it at a much lower rate. So there's a lot, again, there's some weird dynamics that have changed the whole dynamic of savings versus spending. And I think that net worth nest egg is making people feel generally okay. You're still employed, you have a nice nest egg, your house hasn't changed value. And the last thing I'll say about the housing thing, which is really an interesting dynamic, price discovery happens when you have to sell your house, right? So if you have a 3% mortgage, a lot of people don't want to sell your house and pay 7 or 8% to move to a different house. And you may not get the value for your house if you have to sell it because somebody else might not be able to afford it at a much higher interest rate. So I think that you're likely to see prices for housing remain higher for longer because people probably are unlikely to sell unless forced.
Speaking of housing prices, you showed a chart that showed mortgage rates causing housing sales to fall off a cliff. It doesn't feel like that's happening here in New Hampshire. Any thoughts on why?
There's been, and Susan might have some insight on this too. Massachusetts instilled a $1 million tax, right? So I think you're getting some demographic shifts. You're getting people moving out of parts of California into Texas where there's no income tax. You're having companies, financial companies, hedge funds move from New York City to West Palm Beach for the same reason. So I think there's a lot of these natural drifts that are happening within the demographic United States where people are opting for lower tax states versus higher tax states. And it's happened in Connecticut, it's happening now in New York and Massachusetts, and you're just seeing population shift to the lower income states.
Yeah, and during COVID, we saw a real impact on housing prices. You couldn't find a house. We had a mortgage rate that was unbelievably low for first-time home buyers. They couldn't find homes to buy. Even up in the northern part of New Hampshire, where people can work from anywhere now. They don't have to be in the city. They don't have to go to an office every day. I think that's why housing prices in New Hampshire have remained very high.
We have a question from the audience. Ryan mentioned that corporate earnings are expected to turn positive this quarter. More info on why?
So to use a term from the Fed, there's a little bit of base effect that's happening. If you look back to the last year, comparisons get easier. So generally speaking, you have, 2 years ago, you had earnings go up 100%, and then you had earnings go up like 2%, and now you're going to have earnings they're going off a much lower base. So the inflection number looks easier. That's one reason. The other reason is we faced, think about most corporations, the biggest expense is wages and related expenses. We saw huge wage pressures last year, right? And we're still seeing it. I mean, you see it with the UAW and you see it with UPS and some of the healthcare workers that are striking right now. You're still seeing some wage pressure, but it's not what we faced last year. So we're getting less wage pressure. Wages are coming down, and we have a basically easy compare, which make the numbers look better in the out months or out quarters. So it's kind of a combination of sort of, funny math and the real benefit of lower wages or relatively lower wages on corporate balance sheets.
Hey, well, we're just about at the hour, and so it's amazing how quickly that went by. Susan, I'd love to give you the last word here. We, in the beginning, Ryan talked about some of the things that are making the world feel so volatile right now, from government shutdowns to the violence in the Middle East. How do macro scale things like that impact me working with you as I'm trying to decide what to do with my portfolio short term?
Well, we like to talk people off the ledge. I know in 2008, when the market was just really collapsing, we had a lot of clients who called and said, get me out, get me out. Well, that was absolutely the wrong thing to do. Luckily, working with a professional advisor, you have an ear, but you also have some common sense behind the actions. We have a long history We know what the markets have done, what investments have done, and we pay attention to that. So to have someone, a professional, looking over your portfolio on a regular basis, making sure you're positioned where you're comfortable, really, I think it takes the pressure off of our clients, and especially those that have worked with us for a very long time. They know we're looking out for their best interest. That's what a professional advisor can do, and that's what we do for our clients.
Wow. Well said. So thank you, Susan. Thank you, Ryan. And thank you to Cambridge Trust for sponsoring today. Thank you to our audience for joining us. I hope that the rest of your day is fantastic. I'm Ernesto Burden, the publisher of New Hampshire Business Review. Wish you well. Thanks, everyone.